Yeah. Uh-huh. Welcome to another exciting episode of Deal Disruptors. Today we have Brandon Pettagrue, who is the Director of Originations at Stonehenge Capital. And we have Marilyn Adler, who is a Managing Partner of Mizzen Capital. Brandon, please give a little background about your company.
Absolutely. Stonehenge Capital, we were born about 25 years ago, born out of the Chase, Bank One Chase merger. And we essentially have two platforms that we operate from, tax credit services and direct investing. We are a specialty boutique, private equity, private credit, financial institution that seeks to get capital in areas that have typically not been targeted. We have primarily a place-based strategy where we look to get capital into areas targeted for revitalization, but we also target women, veteran, and minority owners as well. So we kind of sit at this crossroads of community, economic development, and finance.
Excellent, excellent. And Marilyn, you're in a similar spot. In fact, you two have done some deals together, but we'd love to hear about Mizzen.
Sure. Mizzen Capital is a women-owned credit platform. We were founded really in 2020. We launched in March of 2020, right when COVID hit. But we persevered and we raised our capital. We have now 2 SBIC funds, as well as we just had a first close on our non-SBIC fund. And we're really targeting companies 1 to 15 million of EBITDA, of operating income. Companies, our areas of focus are in business services, manufacturing, energy transition, and software. And we're really proud of the fact, without any screening or lens on it, 26% of our portfolio companies are women or minority-owned companies. And about 75% of our companies are owner-managed companies, whereas 25% are with an independent sponsor or with a lower middle market private equity fund. And so we're really excited. We've built the team up to about 18 people now, and we just won Emerging SBIC Manager of the Year from SBA this year.
Congratulations.
Thanks.
It's a huge, huge accomplishment. And before this, you both were talking about the solar company that you collaborated on to fund. And I'd love to know from both sides, because you have very similar mission-driven lending and investing structures. Brandon, what did you see in this company? And just describe the overall deal from your end. And then I would love to hear it from your side as well, Marilyn, to see where both sides were aligned, and also if there were things that you both were looking for that the other might have not been.
So full disclosure, it was a little bit before my time, but despite that, there are a couple of things that really, I guess, tweaked our interest about it. And that's, number one, it provided solar panels to a low-income population that just fits within our mandate. Number two, I mean, it's solar, so it's something that's, good for the earth, less reliance on fossil fuels. That's something that is a theme that, we just cannot turn away from. And then, being able to partner with Mizzen as well, another like-minded firm, having other capital providers who see eye to eye with you, that's also just another kind of checkbox that we like. So, I mean, with those three, it's hard to pass up an opportunity like that.
Mm-hmm. Marilyn, what did you see?
So we're really active in energy transition, and we like the solar space a lot. We have another company also that's in the space, that's in Salt Lake City, Utah, that puts batteries into solar panels as well as solar panels themselves. But we really like the idea of this targeting a community, people that can't get credit. And what we found is that people pay their electric bills. So where all the other solar companies are not willing to give them financing, they were kind of excluded. We found here this was important. It lowers their electric bills, and they're going to pay the electric bill. Yep. So to us, it was a win-win. And we reached out to Stonehenge to bring them into the deal because, again, we want to have another partner as these companies grow. Sometimes we'll start out funding a company, and we'll start out funding like $2.5–3 million into a company. Most other credit funds don't want to look at anything under, 50 million or under 30 million.
Mm-hmm.
We like starting a relationship with a company. So we'll start out funding a company with 2.5, 3 million and grow with them over time. We lend based on their EBITDA, or if they have assets or a personal guarantee from a founder. And we'll grow with them over time as they have add-on acquisitions or as they have a growth in their cycle.
It's a very interesting angle on lowering risk, but also doing exactly what you set out to do by finding something in that space. It's very interesting. Now, Brandon, just out of curiosity, for a question for both of you, I suppose, is geographically in the United States or beyond, where do you both operate?
We're across the United States. We'll go anywhere within the U.S. We have money from the Small Business Administration, the SBA, so they're very focused on job growth, and we have to make sure that 50.1% of tangible assets and employees are in the United States. And so that is really our focus. Most of our companies are East Coast, Florida, Texas, California, Salt Lake City. We'll really go anywhere.
And same with us. We have an SBIC fund as well. We're actually fundraising for our second one. With that fund, we can invest within the entire continental United States, but we also have state targeted funds as well. We have funds in Ohio and Connecticut and Mississippi and Oklahoma and Utah. And in those specific states, we're targeting companies that need growth capital. And with those funds, we can be a little bit more flexible. We can invest senior debt, mezzanine, even equity. Whereas with our SBIC, it's primarily credit focused.
Yep. And on that note, you were just recently awarded a $50 million allocation in new markets for a tax credit program. Could you talk about that a little bit?
The new market tax credit program, right? Yeah, well, that program is something that we have been involved in literally since it began back, I guess, when the Clinton administration initiated it. And I think it goes to the point that we've always been kind of community oriented and wanting to get capital to areas that typically have been starved of capital. That's kind of the whole point of the New Markets Tax Credit Program, because it's strictly location based, right? The locations are documented with unemployment rates, high unemployment rates, and high poverty rates. And so the point is, if you target areas like that, typically asset values are low, but if you target companies that are in those areas, you can begin to uplift those areas through the employment of those firms, through the growth of those firms, so that eventually those areas are not distressed areas anymore. That's really the whole point, is so that over time, you can uplift communities by investing in the businesses that are there.
Yeah.
I love that. That's great.
It's a very similar angle, I would imagine, from yours. But yeah, that was very well said.
We're not really targeting minority or women. Those are just our communities is where our deals come from.
Yeah.
I attend a lot of women events, and people just feel, we had one company say they just felt comfortable with us. It's a company, Hispanic owned staffing company that puts employees into hotels in the Southeast. And they just felt that they felt most comfortable with us of all the groups that they were talking to. And so we feel that's an advantage when we're competing, if it's a women-owned business or minority-owned business.
Yep. Yeah, it's funny how much of this industry comes down to actually building the relationships and really understanding the businesses you're working with and also the capital providers you're working with, right? There needs to be a significant alignment there that sometimes goes unsaid, it seems, where, it's not always just papers. So very interesting.
How would you define impact, Marilyn? I'm curious.
For us, it's, again, helping a community, underserved market, or underserved, minority in terms of women or minority-owned companies. And for us, we want to make a difference. We feel very passionate about working with these companies and helping them. And just when you see these companies grow and ultimately exit or just continue to thrive, we got taken out on Posigen, for example, by a large asset management firm called Brookfield, and we're excited with their growth. And another company that we funded called Butterfly, they ended up we were their first $5 million in the company, and they ended up selling to a large private equity firm. But the CEO was very passionate about keeping us in the deal because we were his first money. He felt like he didn't want to take us out till we were ready to come out. And we ended up putting more money into the company to continue to help them grow.
Yep. So the partnership kind of mentality on the capital provider, that's great. So that all happened since the 2020 launch. Just in the last 4 years, there are already two pretty successful exits, it sounds like.
Yeah, we've had more. But again, it's really trying to. We can't help it, but we root for the underdog. We had a woman-owned hotel here in New York City where a bank sold the mortgage on her property to a loan-to-own group who was threatening her. They were going to take over her hotel for being in breach of a covenant. And so we stepped in. We moved really quickly when we funded $15.5 million to take out this loan-to-own group and gave her a year break on covenants. And by the time, COVID was ending, she's, over 90% occupancy. And so we're really excited when we can help a company through a tough, I call them speed bumps, to things that are happening that really not in your control.
Yeah, we all hit them. so that's excellent. And Brandon, what are some of the 2025 initiatives that you have at Stonehenge?
2025.
Coming up fast.
Yeah. I mean, we are raising our second SBIC fund. So we're excited about that. We have a couple of other state targeted funds that are coming online that we believe, I think in Missouri. And I think we have a couple of tax credit programs, I want to say in Nevada as well. So Nevada, Missouri, we actually have a small program in Kentucky as well. So we're just adding to, a nice base of state targeted funds that we already have. And in addition to that, raising our second SBIC fund. So we're pretty excited. We're busy.
Yeah, it sounds
super busy.
It sounds it. Where does all your deal flow come from?
Wow. Well, obviously a conference like this that we're attending, like an iGlobal conference, that's one. But I really rely on independent sponsors that I've met. I get a lot of deal flow just from guys. Maybe I wasn't able to do a deal with them, but they, like we said, it's about relationships, right? So you strike up a rapport. They're like, what, even though we weren't able to do a deal, I want to refer you some people that maybe you can do deals from. So I get lots of referrals from other independent sponsors. I do a lot of work with the Minority Supplier Development Council. So I get a lot of deal flow from there as well. Other capital providers. I mean, it's really just about diving into your network and effectively communicating your parameters. I mean, I think with all of the people that I deal with, they understand kind of, what we're looking for. Like, for example, we want companies to have at least 2 million of EBITDA, up to about 10 million. This is for our SBIC fund. We're deploying between 5 and 20 million when it comes to that fund. But, we do have these impact criteria. We don't necessarily want our referral sources to think too deeply about, is this going to fit, or if it's not, we just tell them, look, just refer it over and we'll kind of make that determination. But
what are some red flags when you're looking at deal flow that doesn't work for you guys?
Oh, okay. I think off the bat for me is when the sponsor doesn't have any capital to put in. For us, that's just non-alignment. But we don't want to penalize them too much. I mean, it depends on if they are bringing some other things to the table, right? I think, as long as they're putting something meaningful in compared to their net worth, we can work with them. But if we're working with someone who has been working on Wall Street for 20, 30 years and, they've done a bunch of great exits and they're saying, oh, we can only put in maybe like 50,000. Like, nah.
Yeah.
I don't,
a little suspect on that.
Yeah, and it's like, I mean, or nothing at all. I mean, I've run into people who are like, no, we're not going to put in anything.
How about we're rolling our fee?
Yeah.
That's not alignment.
That's not alignment at all. We want to be in bed with someone who has the passion and the energy to go after it and to know that if things get a little iffy and a little
Mhm.
tough, that they're going to be there to work with us,
Right.
because we're not going to run away. I mean, our capital is at risk, right?
Right.
I mean, we want to find
Mhm.
solutions, so we want to be linked with people who are solution oriented and who are going to be there at the end of the day.
Excellent. And Marilyn, you spoke a bit about how your network and your team's network is very much in line with your interests and what you're looking to deploy capital to. But how have you built that network over time, and what are the things that you look for, both pros and cons, when looking at a deal?
Yeah, we're really getting deal flow from all different places. A lot of times our CEOs themselves are referring us to people in their communities. So it just starts to expand. Like we had looked at a company in Lakewood, and the acquisition never happened, but the CEO liked working with us and then referred us to a friend of his who had a warehousing company, and we ended up doing a deal with him. And so we have 3 companies now in Salt Lake City, Utah, that like we keep getting referred to other companies in the community. So we really like that. We speak at a lot of conferences. We want to be top of mind. So what I find is some people call me with a company, and a lot of ours are owner managed companies. And when something is not a fit for us, I go out of my way to make sure I have like 3 other referrals to send them to, so that in the future I'll be top of mind. I got to call Marilyn with this deal. She's always helpful. If it's not something for her, I'm going to be connected to 3 others. And as you were talking, I thought of a deal for you. But it's just the way
Amazing how that works.
I love that.
I'm like a great connector, and I get calls daily on deals, and it's like a lot of times it's just not a fit for our box. We're not an asset-based lender. I'll get a deal and that's an ABL. It's like, that's not for us. Let me connect you with a few others. Or we don't do anything in media. So I have groups that I send, media companies to. We don't do anything in retail, apparel. We're women owned, but we do not want to do anything that's a nice to have. Our whole mantra is this product a need to have? So like if it's product or service, like if you have asbestos, if you have some kind of flooding and you need remediation, if whatever, HVAC. We just closed a company in Jacksonville,
Yeah, I saw
Florida,
that.
where they are an HVAC services company. If your air conditioner breaks in, they're going to call you. They want somebody immediately to come in and fix it. So
Mission critical.
exactly. On all our companies, we think of that. And we have an ESG report that we put out every year, where even just asking our companies about what they're doing to lower their carbon emissions, whatever it is, we just bring up the question of what they're doing. And then suddenly they're making more of an effort to either changing the light bulbs with more efficient bulbs, or they're looking at it like, oh, we could be using golf carts instead of cars. And so we just are constantly asking them what they're doing, and it makes them more aware.
Yep. That's excellent. And just the same question, for the 2025 initiatives, what are you looking to accomplish, and what are some things that you see in the market?
So we are, again, we're almost done fundraising for our second SBIC fund, and really our initial investors all stepped up for bigger pieces for our second SBIC, which was great.
I can see why. Yeah,
Congrats.
it sounds like it's been a good 4 years.
Thank you. And then we just had a first close on our non-SBIC, which is a completely different investor base. Like the SBICs is more banks that get CRA, Community Reinvestment Act credit for investing in SBICs, whereas our non-SBIC is more pension funds, endowments, and just a whole different market. So we're excited about that. And just continuing to work with small businesses, whereas many of the credit funds keep getting larger and larger. I guess that's like a macho thing, to keep getting bigger. We like to stay where we are. We love the lower middle market. We want to continue to work with small businesses, and that's our passion. So we also have really great diversity in our team. So we're always looking to, build out the team, bring on more people. But we think the diversity of ideas, the diversity of people, just makes for better decision making.
Yep. And a question about the non-SBIC fund. So the different investor base that you were targeting, how did that change the capital raise? And did it make it easier, harder? What were some of the differences?
much harder to tap into that. You know, the pension fund endowment market is, you know, I guess, you know, people know that the people there for many, many years. It's very hard to break in. It's a little bit of an old boys network. And so it just takes time where we want to start working with some of the pension funds and endowments where we can bring them into a deal that we're working on so they get to know us. But it's really a whole different market for us. And we had to go a little bit larger. Our SBICs are all, you know, a little under 300 million. And so the non-SBIC, we're targeting 250 to 500 million because many funds don't want to be more than a certain percentage of your assets under management. And so we are excited. We just closed our first large pension fund as an investor. So we're hoping that now that we got that first investor in, that others will start to follow.
And how long were you working to get that first investor closed?
It took a while. We really had to like spend a lot of time, show them our deals, really work them through how we think. And, you know, it was challenging, but I just feel like for anybody to access the lower middle market for debt, for credit, it's very hard. Like you can do, you know, you can invest in BDCs and these large credit funds, but you're not going to get outsized returns in the credit space from that. They're all competing a lot on the same deals on these larger companies. And so I don't think there's that many companies that like us focused on this lower middle market and willing to put in small dollar amounts to work.
Yep. Yeah. And on that note, because it is so interesting. So we're all here for the iGlobal Forum ISCP Club Conference, the independent sponsor summit that they have going on this week. And the capital providers all are in that alignment where they're looking to provide in that lower middle market, a large majority of them are at least. And you face that challenge of if you're operating, raising capital in the lower middle market where everybody upstream, you know, is taken care of well, and then the smaller, tiny deals are taken care of to some extent. But what advantages do you see, both of you, operating in the space where you can produce excess returns? Essentially, you can produce some sort of alpha in the space.
Well, even just to win it, I mean, we have the same deal docs on all our deals, same term sheet. So if there's a deal, we can move really quickly. We find that's a real advantage, and we meet every single day, our team. So when someone shows us a deal, we get back to them really quickly within a couple of days of like, yes, this is something that works for us, and this is what we need to move ahead. And, you know, this company that we're closing tomorrow, they're here in New York, and they train ultrasound technicians, and we really like the space. The healthcare space has been really booming, and they have a waiting list for students to come in. And so we just moved really quickly. We were like, you know, we got the deal in. It fit exactly the type of parameters. We felt like this is an underserved part of the market, and we moved quickly, put our term sheet in, and said we can meet you immediately. And so we just find moving quickly and building the relationship with the CEO really made a difference.
Yeah, moving quickly is such a key advantage.
I'm curious, how long was it from term sheet, and like what was your kind of underwriting process on these smaller deals?
So we were really digging in to like look at their backlog of students, the graduation rates, looking at what fields they're filling, their relationship with hospitals in terms of placement, how tuition has changed over time, really just looking at the business and the expansion opportunities. So right now they're in Brooklyn, and they're now opening a campus in Staten Island. They're targeting possibly opening on Long Island or in the Bronx. So just looking at where could the company grow, what do they need capital-wise to execute on that, and just making sure the team is aligned. I mean, his team has been there for many years. We really felt like they were strong. And it's two women that really work very closely with the CEO, and they're amazing. They really have been there for like 15 years at the company. And just for us, it's really digging into the numbers and making sure we don't want a company to get, you know, too leveraged where they're going to run into trouble. And so just making sure that we're looking at the projections and making sure they're going to be able to meet what they set out to do.
Yep. Yeah, it's a lot to get done in a short period of time.
It is.
For
It
sure.
really is. And we have two teams at Mizzen. We have our business services team and manufacturing team, and then we have our energy transition and software team. So the knowledge base starts to build as you do more and more deals in a sector.
Yep, makes sense. And Brandon, same idea. So the independent sponsor space, you mentioned you've done a lot of work with. It's one of your favorite targets. So what do you see in this lower middle market that makes it stand out as a great place to put your capital?
I think, just taking a step back, right? We have in this country thousands and thousands of businesses that are owned by baby boomers. These individuals, men and women, many of them do not have an exit strategy simply because their children do not want to own these businesses. So right off the bat, you kind of have this supply and demand imbalance. You have more businesses that are looking to sell and not enough people to buy them. So, that right there lends you in the lower middle market pretty favorable, I guess, entry multiples, right? And so just like what Marilyn said is, there's just not a whole lot of competition in the lower middle market, especially when you combine that with our place-based strategy of going into areas that are targeted for revitalization. I mean, we're not going into the sexy areas. We're going in, we do a lot of manufacturing. We love business services. We love logistics. We love HVAC, even construction, some of those types of businesses that your commercial banking groups may not even want to touch. But, those are the businesses that aren't sexy, but, you need them. And we enjoy going after them. So, like I said earlier, lower asset values typically going in. But hopefully, as we join in with the independent sponsors and the business owners that we're partnering with, they're bringing a lot of value, whether it's, professionalizing the business or just bringing in, a platform growth strategy so that at the end of the day, there's some wealth creation that has been achieved as a result of the investment. And, at the end of the day, I think that's, what we're all looking for, at least, for the people that we partner with, whether they're minorities or veterans or women, we want them to achieve and get, this American dream that we all know and love.
And being in the lower middle market, we can usually get things like warrants or equity co-invest or personal guarantees that you're not able to get in the middle or upper part of the market.
Yeah. Yeah.
And that really helps to generate outsized returns for the lower middle market.
Yep. And Brandon, so it's very interesting how you're uplifting these communities. And is there any way that you see that these communities could network even better with groups such as yours, where you're going out, you're meeting independent sponsors at the iGlobal conference, but it sounds like there's probably other ways that are out there for this kind of deal flow to be seen by groups such as yourself? Is there, have you thought about that, I suppose, and what are your efforts to kind of uplift these areas?
So, good question. I think one thing that we have done is we have an established relationship with the Urban League. And one way that we always look forward to having a conversation with our portfolio companies is on workforce development. Especially if it's like, let's say like a truck driving school or, something where it's more blue collar, where you don't necessarily need someone who has a degree, but someone who can be trained in a skill, and then they can kind of come in and take care of their families because, maybe they just, weren't able to go to college or whatnot. So, we have a connection with the Urban League where we try to link up these companies that may have a need for different people. Maybe, a lot of these folks haven't, had the best of luck to find the right jobs, but they just need an opportunity. And so that's one conversation that we have quite often with many of the portfolio companies that we talk to is, how are you sourcing capital, labor? I mean, we all know that is one of the biggest bottlenecks with all companies, right? No matter almost where you are in the market. So if we can kind of help streamline that, and in the process, streamline that with individuals who may not have had an opportunity in the past to do that, and now they have an opportunity and they take advantage of it, and they're getting paid a really good wage or a good salary, and now they're able to take care of their family. That's just the bonus. That's like the cherry on top. So that's one of the ways that we try to add value to our customers.
That's actually, I think that's a good closing comment right there. And is there anything else, Marilyn, on this kind of topic that you would like to add before we wrap up?
We always say these are family-run businesses, and it's not really tied to interest rates. It's really tied to family dynamics and what's happening. So it's we feel like the deal flow is really consistent and independent of what's happening really with the economy. When if parents are looking to sell and the kids are not interested, or there's a death in the family and you got to sell the business, like this is life. Things happen all the time with these companies.
That's excellent. Well, Brandon, Marilyn, you two are both doing some great things with capital, and hopefully we can drive some investors your way. And thank you very much.
Thank you.
Thank you so much.
Yeah.